TDFs are not a complete retirement plan, and people seem to lose sight of that. It's almost like they've been sold that this is all you have to do. If you do this, your retirement's going to be set. And I saw it time and time again. It's a target date, especially baby boomers or folks where they're a little more familiar with pensions would often think it's kind of like a pension. Once I got to my target date, there was no volatility. I was set, and nothing else had to be done. So it's not. You still need to plan your income sources in relationship to your assets, Social Security, pensions, annuities, withdrawal frequency and risk mitigation. Your risk is changing in retirement. Your assets have to change too.
Welcome to the Healthy and Wealthy Retirement, where your certified retirement counselor, Mark Struthers, takes a holistic approach to retirement, going beyond finances and embracing holistic well-being. This YouTube channel will address not just the financial part of retirement, but also the social, the physical, and the emotional parts of retirement. Everything you need for healthier, a wealthier, and a happier retirement.
Welcome to the Healthy and Wealthy Retirement. My name is Mark Struthers. I am your host, and today we are talking about target date funds. And we're talking about really how these are bad for your retirement. Actually, in some cases, really bad. So for those of you that don't know, target date funds are something that were designed to do some good. They are a set it and forget it type fund. And what that means is when you are younger, meaning your target date is further off, it's a riskier allocation. And as you get closer to retirement, it decreases risk. And it's called a glide path. And all target date funds use different investments, different indexes, put together indexes, and they have different allocations. And so it's actually something that can get pretty complex because there is no set standard and you really can't have one. And target date funds, while during the accumulation phase, especially when you're younger, are not necessarily a horrible thing. And we'll discuss some of the positives when we're done here. So we're going to go through some reasons why, if you are going into or are in retirement with a target date fund, why they may not be a good idea. Number one size fits all allocation may not suit your needs. We're going to call them TDFs, target date funds. TDFs follow a generic glide path set up by whatever the firm. And we're going to talk a little bit about Vanguards because that's a popular one. And it may be too conservative or too aggressive. And this is part of the problem when you blindly do something. And when you're younger, especially when you're younger, quite often you just need to take on some risk, some diversified lower cost risk. So even when you're younger, ideally these aren't, for some folks, they're not a great fit and you just need to know what you're getting, but the harm is less. And we'll talk about Vanguards when we'll flash up their glide path as well. But for most target date funds, really, they're too conservative, generally speaking, for most people. It also doesn't adjust for personal circumstances, such as if in retirement, you may have a pension. Your pension is like a bond fund. It's a low risk asset. Or you might have Social Security, might make up a huge chunk of your retirement spending. So if that's the case, then whatever allocation they have for bonds, you might not need it or want it, or you might want to have different types of bonds. Maybe shorter duration, longer duration, maybe riskier bonds. Maybe you want to, something with a little more risk, but a little more yield, but maybe goes down. It doesn't account for liquidity as well, or longevity risk. So none of these things factor in. You have a generic glide path, whether you plan on living to 70, 80, 90, 100. So it's true with anything that's one size fits all. There's some pluses to it in that it's an easy decision, but you have to live with the downside. During the accumulation phase, the downside's maybe more limited and you have more time to make up any difference. but also, but is much more critical in retirement. Number two, we have the glide paths are too conservative. And I'm going to actually give you some examples here. We'll put it up on the screen. We're going to talk about Vanguard's glide path. Keep in mind, they're all different. So when you are young, we'll say 25, Vanguard has 10% into bonds and international bonds, U.S. bonds international. And that's not a lot. But for most people in their 20s or even 30s, sometimes even 40s, they want to take on as much risk as possible. If you are trying to capitalize on the magic of compounding that Warren Buffett talks about all the time, you crave risk. You're buying in and even you're buying in during depressions, recessions, but you're buying in. And you're talking about, and again, you go back 50 years, 100 years, when you're talking about that long time horizon, 30 to 40, even longer, you want that risk. And 10% is not a lot, but it adds up over time. So that's why for even young people, target date funds might not be the best fit. Are they better than nothing? They are. We used to have an employee financial well-being side of the business for a default fund where people aren't choosing, they're not engaged, unless they're just selling out of panic or you just give enough time, you're still going to get some inflation adjusted return. It does become more problematic when you get into your 50s, 60s, and into your 70s. So with Vanguard, once you get to be about 65 is considered your target date. If you choose it, it assumes you're 65. Its equity allocation is about, from this, you can see here on the chart, between 50, 55%, somewhere in there, the bottom two colors. That in itself's not bad. For some folks, that's maybe even a little too high. It's about knowing possible outcomes. I still remember we used to give presentations and it was so tough to get through to folks just to let them know what to expect. Especially trying to warn them about inflation and that could happen to what Vanguard does with your bond funds, because they don't, they don't factor in, really low rates. They don't factor in what you might be taking out if inflation hits, but that's another story. So that allocation by itself isn't necessarily bad, as long as you know what to expect, that you could lose a 2009 type event, whatever the number is, I can't remember. So for that particular target, it may be 20%, 25%, if you give enough time. But when you're in retirement, you might be taking money out. Again, it's about knowing what to expect. Where it gets problematic is from age 65 to about 72, 73. And I think they stretched this out. So I remember talking about this years ago, and I want to say it was even quicker. But it goes from, we'll call it that 50% down to 30%. And for some, that's just right. But for many people, when they are talking about 20 or 30 or longer time horizons, and they have goals, legacy goals, they might have long-term care goals, they might need more. They might need to grow assets quicker. You think about the 4% rule is based on a 50% stock, 50% bond portfolio. That's their baseline portfolio for calculating the safe withdrawal rate. Doesn't mean you have to stick to that, but the message from any study in and around the 4% rule is clear. In order to compensate for inflation, you have to take on risk. You have to have a certain equity piece in your portfolio. And I don't remember what the numbers are, but I guarantee you it was a lot lower than 4% if you drop the equity piece down to 30. Now, again, you're in your 70s now, and I'm pretty sure Vanguard moved that a year or two. But that being said, for many, that's just not enough risk. And for some, it's too much. And even what's probably more problematic is when you are in your 50s and 60s and you're going, because I actually at the age of 40, you can see here that they start increasing the the fixed income portion to where at age 50 years old, you're right around 80% or less of stocks versus bonds, which again, for some folks, that's just fine. But for some folks, when they look at that, they say, well, I still have another 15 years to retirement, and I still need to grow assets now, so I don't have to take on a ton of risk when I'm in my 60s. So people in their 50s, that's one thing they often miss is you might want to take on risk in your 50s, especially if you have some flexibility about when you retire. But certainly in your early to mid 40s, that's a time when you can afford to take on risk. So you could see here why for many folks, that target date fund is just too conservative. Number 3, limited flexibility and withdrawal strategies. This one is crucial. There's some folks who become, I don't want to use the word indoctrinated. They become they've been sold the target date fund, and they really just can't look at the issues with it. So quite often you need dynamic withdrawal strategies. TDFs force proportional withdrawals. You don't have an option. So a lot of folks like bucket strategies, where they have usually 3 buckets, maybe in 4, emergency fund or bucket 1 for short-term liquidity, maybe 1 to 2 years, 3 years, and 3 to 5 is your kind of your bond fund or even your ballast, and then your equity piece. Now again, the bucket strategy is not perfect. And quite often it is a way of just kind of managing things, especially mentally and emotionally, but you can't do that with a target date fund. And as I mentioned, the 4% safe withdrawal rule. And that rule is based around if bonds are up, because bonds are the ballast, and it's very clear anytime you dive into this stuff, the bonds are meant less for income, although the income kind of acts as a ballast, but are meant for a ballast when you have 2009 types events. So you don't have to sell the equities when you're down. And it's a way of rebalancing. You're going to rebalance anyway. Why would you be forced to based on those strict rules of the target date fund when you can do it that makes your portfolio more efficient? Also, dividend income-based strategies obviously can't really do this. Some folks like, or it suits them well to have predictable cash flows or low volatility strategies, which makes for a comfortable ride in retirement in many cases. You can't do that. Number 4, poor adaptability to market conditions. So they do not adjust at all. And you see it which again, if you're younger, especially when the bond portion is smaller, well, again, when you're in your 20s or 30s, why is it even there? Unless it's just it's a comfort cash, in essence. That's fine, but you need to know what you're giving up. But think back to 2001 into 2022, or 2020 to 21 going into 22. Rates had been at an all-time low. The upside to bonds were very small. Very small. Could we had negative rates like Europe? We could have, but a low probability event. And again, think about in retirement, things are different. If you're younger with a long time horizon, having your bonds drop 10 to 20%, because you can average into them. They still have a ballast type characteristics to it. But if you were actually managing your money correctly, you can't predict the future. You just can think in terms of probability. You would have said, you know what? There's not a lot of upside to these bonds. Let's go shorter duration in case rates do rise. Now, no one predicted rates would shoot up the way they did in inflation in 2022. Again, we didn't know how long it was going to last. But when you think about trying to manage risk in retirement, don't you want to have that flexibility? Isn't that is more conservative way of approaching things than to just blindly throw money, and they call it duration, because the longer duration a bond is, the more it loses value when rates rise. So why would you just throw money at a bond fund that has a duration of 10 years when there was very little upside to them? It's not that, again, the idea that you would abandon all duration, but it's one of these things where you said, retirement's too important. We need to make sure that we are at least somewhat tilting things in case we do get higher rates or inflation. So you can't do that with a bond fund. And also keep in mind too that when you're withdrawing in a bad market, you can't cherry pick with which assets you sell. So you can't cherry pick the tech stocks when they're up. And again, we're not necessarily trying to time the market, but if you're it's the same as rebalancing. You have a risk return profile. If something's up, and especially if you need income, shouldn't you err on the side of selling what's up and buying what's down? So it amplifies the sequence of return risks. And one thing that's often missed with target date funds, and this is especially true for college target date funds, is when you are aggressively de-risking, meaning you are selling equities and buying fixed income. If you do this during a really bad market, a downturn, you are locking in the losses. You're buying low, you're selling low and buying high. You're selling equities low and buying bonds high. Now, it depends on the glide path. The harm isn't super great, but you think about that glide path we just looked at. When that equity piece starts declining rapidly from age 65-ish to 70, what if that happened right before 2009? So you have this huge drop in the market. And it's a little bit different if it comes back. Like 2020, if it comes back right away, the harm isn't been great. But you're selling your risky assets before they have a chance to come back, and you're buying, and like in 2009, fixed income goes up in value. You're buying in fixed income at the high. You're doing the exact opposite. If the two are separate and that happens, you could say, well, my fixed income's up. Why wouldn't I take some or all, but at least some majority of my income from that asset that has risen in value, rather than selling something at a loss that I know, given enough time. Now, 2009, it could have taken 2, 3, 4 years, depending on what you were invested in, for it to come back. But you see my point. And for college funding, it's even more pronounced because the de-risking happens over a short amount of time frame. Number 5, lack of tax planning and estate planning benefits. So you can't harvest gains and losses strategically, specifically losses. So if you're trying, if you have something where you're harvesting, say the market's down, and you see a harvest that you could lose to offset taxes, and then you buy in a similar, a near identical, similar, don't violate the wash sale rules, but a similar security, you can't do that with a target date fund. And this one's even more critical, is tax location. If you are effectively managed taxes, you hide assets that have a bad tax profile, that kick off a lot of dividends, that have a high churn, that maybe have capital gains because they're buying and selling. With any fund, you need to ask why. But high dividends, ideally, they should be in your retirement account. But if you can't carve those out, you can't do that with a target date fund. Think about real estate as well. So you can't do tax location because you're in a generic one size fits all. Efficient withdrawal sequencing. So in retirement, quite often you come up with a plan based on your profile. Quite often you often see taxable, tax deferred, tax free. If you're quite often target date funds, that becomes more difficult. And quite often you are structuring assets, leaving assets to heirs. It is better most often if you're able to, again, split up assets that have certain characteristics and leave those for some people rather than others, and even just RMDs. You think about if you have taxable and tax deferred accounts or tax frees. Well, In your tax deferred account, one, you might want to hide those dividend paying assets because it's tax deferred. You're not taxed year to year. Also, those tend to grow slower. So you might have lower RMDs, which again is a tax preference to you. And then you could have higher growth assets that may probably have lower dividends in taxable accounts or your Roth accounts. So from a tax and estate planning standpoint, it leaves a lot to be desired. This next one, number 6, it doesn't apply to all target date funds, but quite often you do see some with high fees. Now, Vanguard is one that we see a lot, and their expense ratio is less than 0.1%, I believe. So that one doesn't count, but I do see some that, they get a fund to fund. So one company will have 3 or 4 of its funds in this target date fund, and they'll have fees layered. So the target date fund will have a fee, and then the funds that make up the target date fund will have expense ratios. The expense ratios are what we're talking about here. So, and that's where even just using ETFs instead of these target date funds is a better choice. Number 7, TDFs are not a complete retirement plan, and people seem to lose sight of that. It's almost like they've been sold that this is all you have to do. If you do this, your retirement's going to be set. And I saw it time and time again. It's a target date, especially baby boomers or folks where they're a little more familiar with pensions would often think it's kind of like a pension. Once I got to my target date, there was no volatility. I was set, and nothing else had to be done. So it's not. You still need to plan your income sources in relationship to your assets, Social Security, pensions, annuities, withdrawal sequencing and risk mitigation. Your risk is changing in retirement. Your assets have to change too. So basically, these are just too rigid and too inflexible to be an ideal situation for most retirees. And even those in the accumulation phase, again, as you saw, it's not ideal for a lot of folks. But what are the advantages? So one I call BTN, better than nothing. It's a simple offhands approach. It's why you have auto enrollment in 401ks. You have these as default funds. We want something that can at least have a shot at growing their assets for retirement, and also that doesn't put them in too much risk right before retirement. And this is the best you're going to do. It's within a one size fits all. It's not going to be perfect for everyone. What has made these a little dangerous is that retirement is so much more complex than it was. For baby boomers, they had shorter times in retirement. They often had pensions. It is too tough to navigate retirement and safe withdrawal rates and taxes and everything else that you have going on with these. But another advantage, automatic rebalancing. Again, you don't have to worry about it. You're at least rebalancing towards whatever allocation and glide path that they have for you. And again, BTN, better than nothing. And most of these are diversified. Again, it's better than someone who is 60 years old buying into their work 401k all into a nearly focused, expensive small cap fund that can drop 60% during a 2009 type event. So from that aspect, yeah, if it's diversified and the cost is low cost and reasonable, and that's another one. Quite often you do see these in 401ks, and with companies like Vanguard, they are low cost. So there is some value there. And when you're younger, if you want something where you just set it and forget it and just kind of let them handle it, although I encourage you to look at a robo-advisor who might take on more risk. Because one thing you do see with a lot of these too, they ignore asset classes like small caps. Now, small caps aren't the small caps of 50 years ago. But quite often these target date funds, you're assuming the index they choose is best for you. So quite often looking at a robo-advisor who at least takes some time to get to know your risk tolerance, your willingness and ability to take on risk, you're probably going to be better off. The accumulation phase is a wonderful thing. Do you have more time to make mistakes? Absolutely. But don't squander it. And if you are going into retirement and you have a target date fund, please be aware of what that looks like for all the things we mentioned. For the risk, for the rebalancing, for the taxes, safe withdrawal rates, all those things. And make sure you are comfortable with the trade-off. And that's what financial planning is all about. It's about making informed decisions, and that means being aware of the trade-off. If you want an easy button, if you want something simple, and you think a target date might be it, that's fine. Just be aware of what that looks like into retirement. And if you do those things, you're probably going to have a healthy, a wealthy, and a happier retirement. Please hit subscribe. Thanks for tuning in. If you enjoyed this episode, make sure to hit subscribe, leave a review, and share with your friends. Share the love. Make sure they have a healthier, a wealthier, and a happier retirement as well. Also, don't forget to subscribe to our newsletter for free resources and check out our website and social media pages for exclusive content and updates. See you next time.
Sona Financial, LLC, DBA Sona Wealth and Sona Wealth Advisors is a registered investment advisor with the state of Minnesota. All views, expressions, and opinions included in this communication are subject to change. This communication is not intended as an offer or solicitation to buy, hold, or sell any financial instrument or investment advisory services. Any information provided has been obtained from sources considered reliable, but we do not guarantee the accuracy or completeness of any description of securities, markets, or developments mentioned.